Hey, everybody. Welcome to week 159. We've given Jack a hall pass. He is at another office of Shoemaker somewhere, creating havoc, I'm sure, telling dad jokes in the halls, getting chased out of one office into another. But we do have Ben McDonald back with us with Destination Wealth, formerly BGW Wealth. And he can actually talk a little bit about that, but we've got a lot of stuff to talk about. You guys know the drill. Hit us with a Q&A. You can harass us in the chat. Go easy on Ben. Like we want him to come back.
I've been on here enough now that I don't think they have to go as easy. It's all right.
Adam is in my depersonalized office because I had to move it down a couple offices. So he's in a pretty vanilla office now. Adam, I have a sneaking suspicion that you've got some ideas on things that you want to talk about. Maybe impasse on the debt ceiling. Maybe there's a little movement. I mean, who knows? Who knows? Anything that you want to rant on before we kick it over to Ben?
Yeah. The rant that I really want to do, I will refrain from. But
Adam, you can take the whole hour. I'll just become one of the spectators.
Yeah, no, it's honestly though, what I will say is I had when I first started the company, I was really, really active in the Lake Norman chamber, and I really would credit that chamber for kind of training me on how to be a better business owner when it came to networking and sales and marketing, kind of spheres of influence and stuff like that. Because if you really embrace it, I mean, that you're just kind of forced into developing your chops from that standpoint. And I was and still continue to be an introvert that just fakes extroversion real well. So I went to their leadership Lake Norman graduation class on I think it was Tuesday, which was great, and hung out with Bill Russell, who I consider a really good friend, for a bit. And we've diverged in our political beliefs. And as I was sitting there thinking, man, I can't wait to zing Bill. What I really had to reflect on, Gary, because I mean, you and I zing each other back and forth too. What I really have to reflect on, if I'm being honest with myself, is I have not voted for anybody since 2014. I mean, I have voted, but I've not voted for anybody since 2014. Instead, I voted against, because for me, it's just me. I'm as crazy as it sounds, I'm better with a policy that I kind of marginally don't agree with than I am hypocrisy. So it's like I just, but I also reflected that that's pretty freaking sad. I said friggin', I didn't say the other word.
You're good. You're improving.
That's pretty sad that I have not voted for somebody, because I really reflected on who was the last person that I voted for. And it was in the off-cycle election in 2014, because after that I started doing protest votes. And I've continued my track record of protest votes since then. So anyway, somebody's going to give me grief about, well, how'd that work out for you? But anyway, onto this topic though, I will say, I do think, hey, this thing's going to go okay, based on, the reports that we keep on getting out in terms, and, they'll pull some shenanigan around. Well, technically it's not a default if we do a blah, 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 and we're going to pass a temporary measure and blah, 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 blah. And, if you're reading the tea leaves, probably, people are going to have to work for benefits and probably something around border security. And then probably, there's going to have to be something around like, look, dude, could really, really large companies at least start paying their fair share, and magically, everybody wins, Republicans got something that they wanted, which is kind of, a lot of respects, some of it's just hard to disagree with, like even if you made an argument that under Clinton, when they did the working stuff related to welfare, it's like, sure, you can find stories of where that did not work as intended, but on balance, I think most people would agree that philosophically that's probably not a bad idea. It's just the implementation, you got to make sure you don't have unintended consequences. So I feel pretty good about that. I'm also, I'm excited to have been here and over for several reasons. I mean, I'm excited to have been here just in general because prior to having been in his group aligned with us and all part of one big happy family, people were looking to their CPA to be their financial advisor if they didn't have a lot of liquidity. And if you'd listened to my advice, my advice had been tuck it under the mattress, because if the price to earnings ratio is over 10, you're overvalued. And it's like I was just looking at a chart of PDE ratios, which is, just to put that in perspective, when people talk about, hey, what's my EBITDA multiple? My EBITDA multiple for my privately held company, the price to earnings ratio is the publicly traded company equivalent of the EBITDA multiple, which a good one in privately held companies is 10, so it hasn't been 10. Like I'm looking at it. It has not been 10 since 1982.
I didn't know what date you were going to throw out, but I knew it was going to be a really long time.
Yeah. So it's like, so if he'd followed my advice, he would have missed, some of the historic bull runs that have existed, but you would have avoided all those bears.
Right.
So that's why I'm a lot happy. I'm really happy to have been here to actually give competent financial advice relative to the tuck it under your mattress because this market's crazy advice that you would have been receiving from Adam at the time. So that's what I got today, Gary.
Oh, that's good. So I'll do one additional little tee up for Ben too, because I had my securities licenses, and when our PE firm blew up in 2009, I still have post-traumatic stress from that whole mess. Oh my gosh. And I've had zero confidence in the markets. I've had zero confidence in most financial advisors, even though I had my licenses. I zero confidence. So I kind of took the Adam Boatsman approach from 2009 on and basically kept it in cash, whatever was left, because I got wiped out so badly. But I got to tell you, I met Ben when he did a turnaround of an Edward Jones office up at the lake. And I was on his podcast. That's how we became friends. And then we started the podcast. And then when it became apparent that, hey, we need to do something with our little private equity, not private equity, but our RIA. And I didn't like what we had. It was a single bullet strategy, and I really wanted best of breed. And so we talked to Ben about doing that, and Adam got the rest of the partners to kind of agree that we needed to kind of turn the table upside down in the way that most CPAs approach that if they do have an investment arm, which is, they hire some guy, pay him peanuts, and have them captive. And we're like, that doesn't work. And we want fully integrated solutions, and we wanted somebody to actually own it besides the firm. And Ben was the right guy, and he has taken this thing to the stratosphere. But for me personally, Ben and that team have done a really good job in managing the little money I have been accumulating again to try to, have something that I can, if I have no intention of retiring, but I don't want to live in a van down by the river eating government cheese, so I'm counting on Ben and those guys, but they've way outperformed what's been going on in the markets. And this is not an advertisement about Ben or about BGW Wealth, which is now called Destination Wealth. You could actually talk a little bit about that journey if you wanted to, Ben, before we get into some of the questions that you guys have. Been playing socks and socks. What? I don't know what that means. Joseph, you might want to give me a little bit more. But anyway, there's a lot of volatility going out there. I'd be the first one to say, I don't know what to freaking do. But that's why I've got Ben and those guys. And so, Ben, maybe what you do is talk a little bit about, the progression, our approach, but again, it's not an advertisement about Destination Wealth. It really is about how do we navigate these crazy waters with so much volatility. The market doesn't like uncertainty, and we've got more uncertainty, I think, now than we've had for a long time. So anyway, there you go. All right, stocks. Thanks, Joseph. I figured. Yeah, that's for sure. One's a bear and others a bull to market tech stocks. All right, so Ben, take it away.
Yeah, no, after that tee up, this better be the best advice anybody's ever heard.
Come on, man.
Yeah, so that's fine. I can give you a quick update.
Wait a second. We're going to talk about gold, right? I'm just kidding.
Next 45 minutes is all about gold, mining gold, everything. Well, yeah, but I can give you a quick update. That's fine on the company, and then we can dive right in. So we started with about 6 million in assets under management a couple of years ago when I first came in. And the goal is exactly what Gary and Adam were talking about, of try and make this a comprehensive, integrated experience, right? So tax side knows what the wealth side's doing and vice versa. And everybody's essential, we'll say key players, are communicating and working together to make the wealth side more tax efficient. The tax side can also go back into the wealth. So it works that way. And we built that out. And fortunately, that has attracted the right type of people to be a part of the team. So we've been able to have a Merrill Lynch team come over, an Edward Jones team, a Morgan Stanley team. We've had a few different teams come over and join. And so in that 2-year period, we've gone from 6 million in assets under management to about $500 million. So we've seen some pretty strong growth, but it's more because of getting the right people in the company. So that way, the way that we're serving people is much deeper and much better than what you're typically seeing at a like wirehouse type firm out there. So that's what we've been building. And we'll certainly talk about some of the stuff that we're doing throughout this conversation from portfolio management standpoint and things like that. So that's what you were looking for, Gary? Just a quick little update.
Yeah, I think that's exactly right. And the mandate that we gave to Ben was, we want best of breed, we want solution neutrality.
Yeah.
And we want fully integration, and we want transparency on fees, which most people don't do. And we want the fees to be low and reasonable.
Yep.
That was the mandate to Ben and the team, and they've done a really good job. So Joe, hey, Papa Joe, it's good to see you on here. We got the Josephs and Joe. Is there NIL money available for frequent participants on this webinar? Oh, well, yes.
It's called the Starbucks gift card.
Exactly. But our Starbucks guy is roaming around at another shoemaker office today. So, tune in next week, Joe. All right, sorry.
No, you're good. So let's dive into some of the things going on. And I want to start with a few of the thoughts that we've got internally from Keith Stavasevsky. He's our senior portfolio manager here at Destination. And the first thing is going to be the comparison of just what we've seen from the stock market versus the bond market. And this year to date, we've seen much more stability in the stock market. It's been relatively stable kind of throughout. Doesn't mean it's going to stay that way, but the biggest difference of why we've seen growth is the implied volatility, what people were expecting we were going to see from a volatility standpoint, has been significantly higher than what the actual realized volatility is, meaning what we've actually seen. So with that realized volatility being lower, we've seen a lot more stability in the stock market. We've seen growth. We've seen growth companies, so think NASDAQ, really take off and catch up, make up for a lot of the losses that happened last year. With so many things still on the horizon of what could cause markets to turn back the other way, growth stocks and small companies are still the area of concern, meaning if we were going to see another downturn, that's where it's going to get pulled the most. We're not going to see a major pull from these value companies or companies that have really strong, steady cash flow. Those companies tend to outperform during high volatility. Vice versa, when we see lower volatility like we have this year, growth companies, NASDAQ type companies are the ones that we're going to see outperformance from. Bond market has been complete opposite. So there's something in the stock market called the VIX. If you ever look that up, VIX, it essentially shows how much volatility is in the stock market. For bonds, that's called MOVE, MOVE. And that has still experienced really high volatility. So that index is still relatively elevated. We think that'll continue to be elevated. But at the same time, the Fed has not been nearly as aggressive raising rates. So we've seen inflation being high, but consistently trending downwards, which is mainly because the Fed is easing off how aggressive they are in raising rates. Doesn't mean rates aren't going to continue to raise. It's just not going to be as aggressive as what we've seen in 2022. So that's been a big thing. On that same front, one of the things that is still something we're watching is that treasury curve being inverted. And what that means is longer term bonds historically pay better. Meaning if you get a bond that's 10 years or CDs that's 10 years, that let's say it pays 4%. The 2-year or 1-year CD would only be paying, say, 3% or 2.5%. And that is inverted right now, meaning the 2-year bonds are paying more than the 10-year bonds. Biggest reason for that is people and mainly institutions don't want their money locked in long term because interest rates are still rising. So if you've got a bond at 4% for 10 years and interest rates continue to rise and the new bonds coming out are going to pay 5%, 6%, things like that. Now, all of a sudden, you're either selling your current 10-year bond at a discount, you're selling it at a low because it's not paying as good of an interest in order to get the new one, or you're holding on to it and now you're only getting 4% instead of 6%. So institutions, high net worth individuals want shorter term when we're talking about bonds and CDs for that exact reason. Once we see interest rates slow down from a rising standpoint, we see inflation slow down, that inverse yield will go away, or that inverse curve will go away, and we'll start to see longer term paying more. But for now, that sweet spot is kind of 1 to 2 years when we're looking at bonds and CDs. And so a lot of people are doing shorter term bonds and CDs, or even using money market and not going as long. That, on a side note, is a big reason for the downfall of Silicon Valley Bank. So when we started seeing all these regional bank issues, the biggest issue with Silicon Valley Bank is they were lending money at primarily 2 years, but the bonds that they owned were closer to 9 or 10 years in duration. And so now all of a sudden the bonds they owned were paying 4%, while the bonds that they were loaning out, or the CDs they were loaning out, were paying 5%. That screwed up their ratio of what they were allowed to have. And that led to the downfall of Silicon Valley Bank and some of these other regional banks. So I think that's a good time for us to pivot to what's going on in that regional bank area, because that's that's one of our biggest red flags of what are we actually going to see, and how much is it going to trickle out and negatively impact other either banks or institutions or things like that. One of the biggest concerns that we're seeing right now is there's a regional bank ETF, the initials for it are KRE. That is, out of all of the shares that are out in the world right now, 92% of them are being sold short, which we haven't seen that type of short sell since GameStop, really, a couple of years ago. And that was more because of a movement than anything. So the fact that we're seeing 92% of this regional banking ETF shorted is a massive red flag. It's a huge bet, essentially, on people believing that we're going to see a major downfall in the regional bank world. And our concern is how small are these banks going to be? Are they going to be the Silicon Valleys of the world, or do we start seeing it trickle up and get to larger banks? I mean, we're certainly not thinking it's going to be a Wells Fargo, Bank of America type issue. The cream of the crop so far has been JP Morgan as far as just how they've navigated all of it. So we don't think it's going to impact the really large banks, but do we see small banks that people haven't heard of until they make the news? Or are we going to start to see some actual mid-size bank firms that are defaulting or even collapsing because of all of this stuff that we're seeing on dual fronts, one on the inverse curve and also on so many institutions shorting the regional banking sector right now. So I'm going to pause and stop for a second, see if there are questions, either Adam or Gary, that you have, or if there's questions that have come in from some of the attendees.
Yeah, so Robert Mayetta, so good to see you. Yeah, you and Papa Joe should be, well, I think you've actually taken home the lion's share of these Starbucks cards because you've been camped on here and you're smart. Yes, good question. So here are a couple thoughts that he has raised. So he said the old VIX is a predictive tool dead due to one-day expirations. He says the breadth of the market is what's the portion of the stocks that are participating in the rally. At this point, only 10 to 20 stocks are pushing up because of AI prospects. Broader market's flat to negative over the last 60 days.
Yep. I love that you mentioned that second one, because it was one of the points that I was going to bring up this year. There's really 9 stocks, and I don't have it in front of me, but there's 9 stocks that are making up a significant portion of the performance. So even though NASDAQ is up 20% this year, it's really 7 of them in the NASDAQ that are completely driving that. So when you still look at the United States economy, the general stock market, right, the total stock market, you're absolutely right. We're seeing things relatively flat. You're seeing a significantly small number of stocks essentially dragging the rest of the sector along, or the rest of the index along, both for the S&P 500, but mainly in NASDAQ. And that point of AI is the biggest thing. I mean, look at what happened with Meta, which is Facebook, when they were all in on virtual reality and their Meta platform. The stock got crushed for about 1.5 years, and yet they stuck with it and they said, this is what we believe in. And on one of I think their most recent earnings report just mentioned the fact that they were pivoting away from solely focusing on this Meta platform and trying to begin to implement AI. And the stock, I think, grew like 25 or 30% in one day. It's AI right now is the sixth wonder of the world, where if a stock or company is mentioning that they're doing something with AI, everybody wants it. And just like anytime there's a fad or a phase, and I don't think AI is a fad by any means, but anytime there's something that is being so blown up, you're going to have these massive winners and losers. So there's a lot of money to be made in the short term because everybody just wants a piece and they don't know where to go. So is it going to be Microsoft? Is it going to be Google? Is it going to be Facebook? Is it going to be one of these other smaller companies that are doing things? Like people don't know yet. So everything is rising really quickly. And that's been definitely the biggest driver for the growth in the NASDAQ space and a little bit in the S&P as well so far this year. So.
Yeah, it makes me think of 1999 and 2000 when sock puppets and the more money you were burning in the .com world, everybody was chasing it because we believed that the internet was here to stay, that e-commerce was going to be big, but there were so many losers. Like, we believed in the concept, but yes, I had money in March 1st. It was the biggest .com, web development firm on the planet, and boom, it cratered, and I kept buying stock as it was going down. Don't do that. So anyway.
Yeah. So is it similar to the .com bubble is one of the things Robert just asked. And there are certainly a lot of similarities. And just like out of the .com, Amazon came out of it, right? And there are going to be these massive winners, some of them being obsolete names. One big difference we're seeing right now is a lot of these large established brands are leading this charge, which that didn't happen nearly as much back in 99. There were so many obscure names that all of a sudden became relevant. And then they went to zero because this was the only thing they were hinging on, was this .com bubble. And if you search, there are lots of these small AI companies that are trying to hinge on the same thing, but we're also seeing the Alphabets, which is Google, the Metas, which is Facebook, the Microsofts. These companies are these massive, large established businesses. If they don't win, are their stocks going to be hurt? Are they going to give back the gains that we're currently seeing? Sure. But they're also not companies that are going to zero the way that we saw so many investors lose everything during the .com bubble because they were betting on a different type of company. Does that make sense?
Yeah, that's a really good point, because if and I think I've mentioned this before, but we put $1 million with a competitor that had a $40 million a year burn rate on $1 million top line, and they sold for 225 million to NBCI, and then 18 months later they were gone, and the founders and the top guys did extremely well while the carnage was rampant with hundreds of people, and a lot of people that's just in their company. But I mean, that was crazy. So, I think you make a really good point. Joe raised another interesting thought. He says, it's interesting to me that our own North Carolina bank, First Citizens Bank, took over SVB. Yeah.
Go for it, Adam. What were you gonna say?
Well, I mean, we hit that on a couple webinars ago. It's like, to me that was crazy. Like, you talk about, so JP Morgan Chase taking over First Republic makes total sense to me. A bank that prides itself on its conservatism and involvement in its legacy of being an agriculture bank taking over a Silicon Valley bank does not make any sense to me. So I have wondered a lot about that one. That feels like one of those, hey, on paper, this is going to work out really well for us. And then they're getting into the mix of like, well, how do we really run this? I mean, we have a client that I talked to that was a Silicon Valley Bank customer that is on some message boards with other Silicon Valley Bank customers that are in the CFO role, so kind of in the ability to make banking decisions. And they, they're like, I don't see how this is going to work out. So we don't see ourselves being here for very long. So I do wonder about it. And I guess related, Ben, love to kind of get your opinion on, if you have one, you hear what you just said, which is, hey, we're making bets on the fact that there's going to be some more bank failures. And I think of that in the context of like, okay, the wiping out of shareholders versus losing my actual money, or my loan being called, due to it. And I guess, my own experience has been, both in the past and now, is that, okay, what really happens is that, I didn't lose, like, a bank didn't truly fail. In other words, like when Lehman Brothers went down,
Yeah.
nobody actually lost their portfolio. When Merrill Lynch was acquired by Bank of America, nobody actually lost their portfolio. Now the shareholders took a bath, but nobody actually, no actual customer,
Hmm.
even though it's technically possible, no actual customer actually lost anything. So I, my own personal feeling is like, it is a risk if I'm with that bank that could be on the radar, because then I go take my money out and then all of a sudden everybody starts taking my money out. And guess what? It's a self-fulfilling prophecy. Now I failed.
Yep.
So I do kind of wonder about what people are, what people are thinking, about this whole, small to mid-sized bank market um going down.
Yep. Well, and we've also seen it with the ones that have collapsed or failed already, that the the government has come in and not bailed out the bank, but has guaranteed uh cash over 200, the FDIC 250,000, right? And things like that. They've made other measures to make sure the customers of these banks are being protected and taken care of, but even if it's before the shareholders, right? And there's definitely part of that that is different than what we saw in like 0809, of those customers being taken care of. So yeah, I mean, our thoughts internally are right in line with what you said, Adam. I don't think it's as much of a risk as an individual business owner or individual personal banking at these banks, as much as it is of us investing in those types of companies, because we think there's a much greater chance of those companies failing or suffering dramatically from a stock value standpoint. So that's what I was meaning earlier when I was talking about that, of we're looking at more as investing than we are as being a customer of that bank.
Yeah, I figured that was probably the case.
Yeah. No, but there are reasons that we really like the larger ones, right? The JP Morgans, BlackRocks, there are lots of things we still like, because as interest rates rise, banking stocks tend to do really well, right? Because now they're earning more interest. And obviously there's a catch-22. You also get the other side where they're not issuing as many loans and that type of stuff. But the larger ones have the scale and the margin to where we like these really larger mega bank stocks. We don't like the small regional type bank stocks right now. So, did that answer your question, or did you want me to go deeper onto something there?
No, you're
Yeah.
good, buddy.
Okay. All right. Sounds good.
So I've got a question. This is gonna be a little bit of a hard left, but
Yeah.
crypto was big, 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 big.
Yeah.
Or right. And it's not getting a lot of headlines right now. What are you seeing?
No,
in
but
that
Bitcoin
world?
is the best performing asset in the United States, basically, for 2022 or 23, I mean. So it's not being talked about as much, but yeah, I mean, I'll have to look up what Bitcoin's at this point, but when I last looked, it was up, I don't know. And I know it's gone down a little bit. It was up like 70 something percent for the year. Let's see. It is, yeah, 63. So it's still close to what it is. So it's up 63% for the year. So even though it's not being talked about as much, the banking scare and the news around the United States losing its reserve currency status have both of those things have driven people to Bitcoin and Ethereum, primarily Litecoin a little bit as well. A little bit of Ripple, because Ripple interacts with our current banking system. But yeah, it's not being talked about nearly as much. there's certainly less volume in cryptocurrency than what there has been. But at the same time, we're seeing a massive bounce back in performance from of cryptocurrency compared to what it had been. So
Interesting.
yeah.
All right,
So
cool.
it's still one of those things that my take on it is the technology behind it, the blockchain, the security, those types of things behind it. There are at least parts of cryptocurrency that will be utilized in business. Whether it's something like Ethereum where we can write secure contracts that can't be edited, or if it's something where it's an actual currency play. I certainly have no clarity on that. And anybody that says they do is just guessing. But the technology behind it is real. And so I have no problem with that being a small piece of people's portfolio if they're fine to sit on it and ignore it for a long period of time, because this is not an overnight thing. Even when you start to see people accept that whatever a blockchain technology is going to be utilized in business, the implementation itself is still going to take a long time. And we still don't know which platforms or which currencies or anything like that are going to be the winners. So I don't like the concept of going and taking really small bets on the Dogecoins of the world, right? That have no applicability. It's just people trying to make money quickly. If you want to gamble and play by yourself, I mean, more power to you, right? People go to Vegas and put money on black for their like college tuition and hope that they get it. Like if you want to go gamble on those types of things, that's fine. Just understand that's what it is. But when you start getting into these bigger, more sophisticated cryptocurrencies, you're seeing real technology that has applicability. And so I have no issue with clients having a under 5%, but a sliver of your portfolio being allocated to that world.
Yeah, I think, and you nailed it, man. I mean, who's going to be the winner? Just because the technology is the better, beta versus VHS is a great example. Beta was superior, it lost.
Yeah.
Fisker was a lot better looking car than the Tesla, it lost. So I don't know. Now, here's an interesting thing. This just came in from Paul Pelosi. Paul Pelosi says NVIDIA is up over 100% year to date, and that beats Bitcoin. So Paul's grinning like a Cheshire cat.
It's funny that you say that, Robert, because I don't know if I heard about any stock more than NVIDIA last year from Keith, from our senior portfolio manager. He was all in on it, just loved it, believed in it. We were trying to find options to do for it if they were at the right price. It was like whatever exposure we could get to it. We own it in our growth stock portfolio and have for a while, and kept buying more as it was going down. So yeah, that's definitely one that we liked and are fortunately seeing the benefit of. So when I made that Bitcoin comment, I didn't mean it was literally like the best investment out there, right? You can find some small cap stocks that have gone 10,000x this year. All I meant is that type of investment compared to you take Bitcoin and Ethereum and all that being up 50 to 70% versus NASDAQ being up 22%. I was talking more style of investment.
Yeah, so this part of the discussion's been kind of lively. So Joe weighs back in, says, speaking of large banks, when Jamie Dimon was in Charlotte, he was pro blockchain technology, but anti-cryptocurrency.
Yep.
You have any ideas why?
Couple of reasons. One is what I was saying earlier. It's when he's saying pro blockchain, he's talking about the technology behind cryptocurrency. So yes, I think that's what I mean by applicability. You can take this technology and use it, right? Real estate agents could take the technology of blockchain behind Ethereum and use that for the contracts to sell their houses and have it be a much more secure, stable way to do all the contracting of buying and selling a property. So that's exactly what he's talking about, is the technology behind it. When you talk about just cryptocurrency, what you're talking about is you go to the store and you buy milk with your Bitcoin or your Ethereum. That's what he's saying he's anti on. There's a few reasons why. One is just the United States still being so strong. If we did lose the reserve currency, there's obviously a greater chance that maybe the world can move to a cryptocurrency, but our entire banking system would have to change, right, for that to work. Another thing that we've seen is the psychology behind it. So there are some countries out there, small third world developing countries, but still countries nonetheless, that have made Bitcoin their currency, all right, of their country. And now when you go to buy that same milk, you're buying it with like 0.00002 Bitcoin. And so the mental psychology behind wrapping your mind around that, it's such a small, insignificant number, and one Bitcoin is 27 or 28,000 US dollars. There's certainly the mental aspect behind it. And the third reason is the instability. You just can't have a currency that one day can be $50,000 and the next one can be 25. Right. That makes no sense. And we've seen people in especially the sports world where they wanted their contracts to be in Bitcoin, and they thought this was the greatest thing because they were going to lock it in at whatever X amount of Bitcoin, and that's what they were going to get paid. And they just thought it was going to keep going up. And now they're making less than half of what they were making because the value of Bitcoin went down so much. You can't have a currency that's that unstable. Right? It just doesn't work. You buy a house for 10 Bitcoin today and you're buying it for 20 tomorrow, but it's the same value of US dollars. And that makes no sense.
Yeah. Let's see. Oh, Robert says Jamie Dimon said he will not bail out any other bank failure. FDIC is running out of money. Are we running out of options on the bailout of these small banks as the pressure continues? Is this the beginning of the end with the fiat dollar, where we're going to be forced to a CBDC?
Remind me what's the initials of CBDC stand for?
Yeah, Robert, you're talking like
central
a banker.
bank. Yeah, central banks. I couldn't remember.
Okay.
Yep. Thank you. Appreciate it, Robert. Yeah, so I don't think we will see that, because that still goes into us as a whole accepting digital currency, cryptocurrency, right? Whatever, any of those, whatever you want to call it. There's a greater chance, obviously, if we see the United States lose its reserve currency status, because you're either going to see a different country be able to take that, or you're going to see the developed countries come together and agree on or create a CBDC, a central bank digital currency. One, I don't think we're at least around the corner, and Adam, Gary, you guys may disagree, and if so, please chime in, of us losing that reserve currency status. Certainly can. Obviously, we're at a greater risk today than we probably ever have been, but I don't think this is happening, at least not in the immediate future. But if it did, that's the thing that would open the door to a digital currency becoming relevant. Because just like I was saying, Bitcoin goes from 50 to 25 to 18 to 30 and bounces all over the place. There is a Bitcoin Cash. There are cash versions that are much more stable. They're stable funds. So something like that would need to be accepted broadly and utilized, because when you're in a global economy, everybody needs that currency that we're relying on. And if everybody has a different one, and some of them are moving all over the place the way others are, there's nothing to rely on from a global economic standpoint. And I think that's the issue. I do not think gold is going to be the answer. Robert just put gold with a question mark. No, I don't think we're seeing us go back to the gold standard anytime soon. But yeah, Adam and Gary, I don't know if you guys disagree on what I just said of the reserve status.
Well, it's funny because former Clinton advisor Dick Morris, he did a lunch alert. I never listened to his lunch alerts. He's kind of an interesting cat. but he said there's no way that the Chinese currency, the yuan, is going to take over, and he had his reasons. But I did find another article from markets, from Business Insider, and yeah, it says de-dollarization has started, but the odds that Chinese yuan will take over are profoundly unlikely to essentially impossible.
Yeah.
And a number of reasons. I mean, yeah, we print money like it's going out of style at times, but they manipulate their currency so badly. Like, how, as untrustworthy as we are, and I think we are untrustworthy at times. I think, I've done business with Chinese companies, and it's amazing to me how, hey, we had an agreement. Oh no, it doesn't even matter if it's in writing. It doesn't matter. And it's like, not all Chinese companies, I'm sure, are that way, but man, the experience that I've had was crazy. So I just think that's the case. Can you trust it? Is it being manipulated or not? And so,
Yeah.
Again.
But this has certainly happened throughout history, right? So if anybody is interested in learning more about this, it's a big book, but it's very good. Ray Dalio, he's the founder and the guy that runs the hedge fund Bridgewater. He's got a book that he put out, I think last year, maybe the year before at this point, called Dealing with the Changing World Order. And
yeah, that was good.
Oh, so good. And it took you through the rise and fall of the British Empire, the 2 or 3 times of China being the primary empire, the rise of the United States. And it also talks about signals of what to look for when you start to see a fall, which is one of the conversations that's happened a lot of, is the United States in that downfall from the world order? And if so, do we see somebody else immediately take it over? Do we see the US be able to bounce back and hold on to it? Do we see a large period of time where there isn't a easily viewed world order? But yeah, I completely agree. I don't think China's in any place for us to start using the Chinese currency as that standard.
Yeah, I think. Go ahead, Gary.
Yeah, I was going to just say that that if anybody wants to Google it, I'll see if I can find it and put it in the chat. But there's a video on YouTube of that Dalio, like, changing of the world order or whatever. That was really interesting to watch, and it's probably 15 minutes or something like that. It's interesting. And Joe, before you take it, Adam, he said the Chinese and North Koreans stand to lose if the U.S. currency loses its status because they produce the majority of the counterfeit hundreds in circulation. I don't know if that's true or not. I haven't seen it, but it kind of could make sense. All right, so take it, Adam.
I was going to say, like, very, very similar to the discussion on, hey, should I move my banks or not? It's like, if I roll back to my serenity prayer, Gary, I'm definitely putting that in the accept the things I cannot change.
Yes. Yes. That's wisdom.
Not a damn thing that I can do about it. So, let me at least focus on things I can do, something about. So,
the one area that Asia, specifically China and Japan, could lose on is, I think China and Japan own almost 50% of our debt, right? So if we start to see the United States drop and not be able to take its debt, you're going to see a weird relationship between the United States and developed Asia. For that reason, they own, like I said, about half of our debt right now. So.
Yeah. So given all of these things, everybody has an opinion, just like we all have belly buttons, and it's like, what trends and just some kind of basic fundamentals are you guys recommending now that may be different than it was even a year or so ago?
Yep. So one of the biggest differences is, what are we doing with cash? we held more cash than typical last year in clients' accounts. And a lot of times it was between 8 to 12% of a client's portfolio. And there are enough short-term options between us doing like bond or CD ladders. The money market that we have access to now pays about, I think it's 4.5%. So we are doing more with short-term money and earning more with short-term money. Of we can get CDs and build a CD ladder that's paying 5%, and we can have liquid cash that's paying 4.5%. So we did something with a joint BGW and destination client here recently, where they took their operating money from most of their bank accounts, the business bank accounts, and we were able to move it and do a staggered between how much money do they need liquid that stays in the money market paying 4.5% currently, and then how much money do they need short-term access to and no volatility. And we were able to build a CD ladder that was paying a little over 5%. And instead of it sitting at the bank, I think they averaged like 0.2% of where they were banking. Now all of a sudden they're making real money on it. So that's been by far the biggest shift we've made, is being able to serve companies, especially, because you're sitting on more money because you need operating capital. Being able to now all of a sudden have that earning 4.5 or 5% instead of earning 0.2 to 0.5. That's been a big shift for sure.
Yeah, I'm glad you brought that up, because that is a strategy that probably didn't make sense even a couple years ago, but now it does.
Yeah.
And
it was so nominal a couple years ago that
right.
you get to earn another 0.2 or 0.3%, but now you've got a headache of moving things. It just wasn't worth it. But it's such a difference now that, yeah, absolutely makes more sense.
All right. Oh, go ahead.
No, you're fine. What's up?
So Robert has this point: as people move money out of banks to chase the interest rates of money markets, this only puts more pressure on the banks.
Yep, it absolutely does. And if banks are going to pay, and there are some banks that are giving high yield savings accounts and things like that, where they are creating solutions. But we're in a competitive market with everything, right? When you price your products or services, you're putting pressure on competitors and vice versa. And this is the same thing. We happen to be on the Fidelity platform. It's like, okay, if we can get a Fidelity money market paying 4.5% and your bank is paying 0.2, yeah, that's going to put a pressure on your bank to either come up with a solution to keep your money or no longer be relevant in that aspect, at least. There's certainly a lot of other aspects that banks are doing that none of these other custodians are doing, right? Lending and that type of stuff. So I'm certainly not saying they're becoming irrelevant. I just mean, you're right, they're going to put pressure, but I don't think that's necessarily a negative thing. I think it forces them to be competitive in the yields that they're offering their customers.
Yeah, and I think that also brings up another point, which is, let's look at the continuum. Like, I like bracketing, where you take the two extremes and kind of find the middle, right? So one extreme is set it and forget it and never do anything about it. I've taken that approach. It hasn't served me real well. And the other one is, day trading or hour trading, where you're just like trying to time everything and you're just driving yourself crazy. And I know people that do that. And I know one guy that did extremely well until he went backwards a little bit and then started falsifying and got 7 years in a slammer. And he was really good. And he was a multimillionaire from it, but got behind, and as good as he was, he couldn't, and he lied. So he paid the price for it. So like those two extremes. But I think the point is like, have somebody that is monitoring this stuff. If you don't want to do it, if you're busy running your company and you want to focus on that more than anything, then have somebody that is paying attention to it and have a conversation with them. It's just like anything else. In taxes, you need to have conversations on kind of a regular basis as to what should we be doing. Your needs change. We're not trees. We don't just stay in the same place. We need to move. So anyway, I think that's a great point.
It is. One of my favorite reports that JP Morgan puts out every year is 60-40 portfolio with an advisor versus a 60-40 portfolio of somebody just doing it on their own, and then inflation. And these numbers are a little old. I don't have the updated ones, but over the last 20 years, an average investor by themselves has earned 2.4% per year. Inflation in that time was 2.3% per year. And with an advisor was 6.9, I think, 6.8, 6.9% per year. And it's not because advisors are geniuses and know what stocks to pick. It's because individuals historically doing this stuff on their own are reacting emotionally, right? Because it's their money, so rightfully so. You can certainly understand that, but it's I'm going to sell because I see my money going down and I don't have an actual strategy in place. And it's just taking the emotion out, having an actual strategy. When are we being proactive? When are we being conservative? Like, you have to have those rules in place. And so if anybody on here, like if you and your advisor, whoever you're working with, doesn't have like an investment policy statement, knowing how you're actually doing things, that's when you're going to get yourself in trouble, because you don't know what to do or when to do it, and your advisor doesn't know what to do or when to do it either. You're just kind of making it up as you go. And I mean, you've heard the analogy in business sometimes of we're building the airplane as we fly. That may work in a startup world, and a lot of times it doesn't, right? But sometimes it can. But doing that with your portfolio and your investments makes no sense. There's no reason for that. So you should have that investment policy statement. You should have those strategies in place. So when the markets go haywire, like we've seen for the last year and a half, you don't need to panic, because you know exactly what you're supposed to do. Your advisor, your portfolio manager, whatever, knows what actions to take. And then it's just executing the plan. And that's so much simpler mentally, but also from the strategy standpoint.
Yeah, that's good stuff. It's usually the basic things that elude us, like we want to complicate things.
Yeah.
And if we just stick to the basics and just do them, we're usually way better off.
Yeah. And I mean, don't get me wrong, Keith is unbelievable at what he does, and we've got an incredible team, but he also doesn't have a crystal ball, right? And so the fact that our performance could have been so much better last year, it's not that crystal ball. It's just, we just put strategies and plans in place so we can keep our clients on track. So you're right. Everybody tries to overcomplicate it, and it really doesn't need to be. In fact, most of the times when you do that, you get yourself in trouble.
Yeah, that's good. Well, as we're rounding up towards the top of the hour, Adam, any other thoughts you've got? Any other questions from the gallery out there?
No, just don't put it under the mattress. This too shall pass. Never a bad time to be in, as long as you keep it in.
Right. Yep.
Yeah, that's good. Very lively discussion. Thank you guys for chiming in on this. I mean, dealing with money, and especially cash flow. Like, cash flow is a big thing. And what do you do when you're running a company in the midst of all this uncertainty, all this volatility? I don't know. It just feels like the last 3 years, there's one constant, and it's been uncertainty. It's like, dang. From 2 weeks to slow the spread, here we are. I have a friend, an F3 buddy. He's been vaxxed and boosted 3 times, and he just had his 3rd round of COVID. I'm like, even that, it's like, what's the deal? I don't know. It's just crazy. So at least it's not seemingly as severe as it was 3 years ago. So that's a good thing. So anyway, anybody that came on here late, if you missed something on the front end, oh, awesome. F3 Cubby here. Yeah, I'm Rock Chalk. So good to have F3 guys on here too. And it was started in Charlotte, just like the Charlotte Mint. And Charlotte FC had a good game last night. So anyway, if anybody came on here late, we'll put it up on the BGW CPA YouTube channel next week. Adam will be back, and so will be Jack, and Gary is going to be on an airplane going to Kansas to see my niece get married. So I'll miss you guys, but thank you. Yeah, thanks, Chris, for chiming in here. We appreciate it. You guys have a great rest of the week. Enjoy the day.
Thanks, guys.
See y'all.